So I'm going to kind of kick it off as normal, everybody. Thanks for your time. Hopefully you've enjoyed the series. Last week was phenomenal. We talked to Joe Arroyo, who is really having some phenomenal success. We ended up talking an hour after the call about some of the things he's doing, and he is interested in opening up and open to doing a future call and sharing some of the details of how he's going in and cracking open these real estate, these closed offices with some of the education he's doing. So hopefully you guys are taking advantage. If this is your first call, you can go to our YouTube site. We have our first 10 recorded calls in the series. They're each 1 hour. Each of them features a great deal of both case studies and insight from some of the wonderful people on our network, like Trevor, who's on our call today. We share best practices. It's really a wonderful series to just sit down and go through over time. Mindset meets skill set. What does that mean? It means that at the end of the day, this is about learning a skill, learning to operate differently in the way you do your business. And to do that, it often takes a shift in mindset as we think about what we do and how we do things just a little bit differently. I'll share with you, a slide that I've shared each week, and that is, it's not about what the software does, it's what the user does. So obviously the software will do a lot of things, but many of us are here to learn about some of the features and things that they may be unaware of, or ways to position. A lot of the emails that we get, the cases that come in throughout the week have to do with, how do I do this, or I've done this, is there a better way to present it? And we really appreciate the opportunity to help you guys think that through and figure it out, because we see hundreds of cases over the course of a month, and you might be doing 5 to 10. Now there is a premise to this in terms of what we're trying to do, and that is take this investment of time, money, energy, and licensing and marketing and tools and systems and training, etc. All of that is just table stakes for you to get and be in a position to receive a lead. If you do all that, you invest all that money and time in getting a lead, and you get that opportunity with a client, and they come in the door and they want to meet with you and talk to you, what happens then? What happens to that first interaction? How do you set yourself apart? In our last week call, we talked about literally rendering your competition irrelevant by the way you set the table for what it is that you're about to do, the experience, and how it's going to be very different than anything that they've probably experienced before. If you do that and do that well, all the money that you make that money right here. If you think you're getting paid to process 1003s and paperworks and follow up and chase information, that's not it at all. All right, the doctor can come in, look at you, and take 20 years of experience and diagnose you very quickly. That's what you're really paying him for. You're being paid to solve problems. And that's becoming clearer and clearer in terms of both the way you operate in your business and the software. And this came in today from a friend of mine who went to the NBA town hall yesterday, where the CFPB was talking about some of the new legislation under Dodd-Frank and also the CFPB. And he said that the impact that will most likely be acutely realized will be the field audits of the non-depository mortgage companies, meaning they're coming to your office to audit your way of doing business and looking at what you do and how you do it. The anti-steering provisions are going to affect creditors, depositories, non-depositories. It's going to affect not only your compensation, but the penalties, if they find that you've done something wrong, will include actual damages, treble damages, costs, and attorney's fees. Now, this isn't exciting stuff, but it's just something that I want to point out, because one of the things that he mentioned was that if someone goes into foreclosure after you've done a loan for them, the statutory 3-year limit is waived completely the second they go into foreclosure. And that Mr. Andrino, Richard Andrino, who was speaking on the CFPB panel, said that you needed to know, as an audience of lenders, bankers, and brokers, that you'll need to document how the borrower reached a loan product decision, and that needs to be retained in the documentation in the file. So how the borrower makes a decision to borrow and what they borrow will likely come up in every future foreclosure defense case that they see. Now, these are not lawsuits where someone just decides to sue you. This is just a mandatory. If they go into foreclosure, all statute of limitations gets wiped out. You're now responsible and will be required to show how that decision was made. How were you able to influence that person, what type of steering or non-steering was done. And that's where, when we look at the components of compliance here, compliance is no fun to talk about. I'm interested in talking about sales. How do you increase your conversions? How do you go out and build relationships? But there's a critical, important part of this whole thing. When you look at this model right here, this money that you make, it's no fun to give it back. It's no fun to have your company have to pay it back. So a lot of this, and the way we're structuring this, is in a way that will protect you. Many people don't realize this, but if you delete a file in our system for a client, we don't delete it on the server. It stays there forever. So that if there's ever a need to go back and pull up a file in the future, we have that file in the archives. And we do that for compliance purposes and for regulatory purposes, because we want to be able to help protect you and protect the companies that you work for. But we're looking at other archival methods, one being the recording that we're going to have the ability to do here in about 2 weeks, where we're going to integrate the voiceover and video recording into the system. Those can also be archived with the plan, because we've had a couple of institutions ask, if you have a presentation done in your system and my loan officer does a recording explaining it to the client, can we archive that? So we're looking at archiving and syncing that to the plan, so in the future, if the client says, that's not what they said, or that's not what they told me, wouldn't it be nice to be able to come back and say, I can show you exactly what I showed you. Here's an archival recording of the actual presentation that we did. So these kinds of things are all coming together. As I like to say, compliance is suddenly fusing with sales. It's all about sales. That's how you succeed and prosper in this business. But with the new sheriffs and the new guidelines and things, we have to make sure that we do that as best we can. The only tweaks we've made in the last week that we made live had to do with regulatory type compliance tweaks we made to open house flyers based on some feedback from some of the compliance officers at some of the companies we work with. And I'll share with you in a minute some of the other changes that we're working on and when those should be live. What questions do you have to answer? I mean, if you're a client and you're sitting there and you're working with a client, you have to answer that critical question: do I have the cash to do this, whatever the transaction? Today, we're going to look at 2 case studies that came in this past week that I thought were interesting. One was a client had a first and a second, and they could not consolidate the two, and they decided they wanted to pay off a portion of the second mortgage with proceeds from the first. So we'll kind of take a look at that one. And then we'll also look at another scenario where someone had a lot of liabilities and couldn't sell their house, and they wanted to basically just go buy a new house. In any of these cases, ask yourself, do I need to know if I have the cash to do this now? The answer is absolutely. Do I need to know if I need to have the cash flow to make this work? And the answer is absolutely. And can I afford it over time? I mean, if I have the cash to do this now and I have the cash flow to do this now, in 5 years, am I going to be worse off by 40 or 50,000? Because if that's the case, I don't want to have the cash and cash flow to do this to find out 5 years from now I'm worse off financially. So what we're gonna do is we want to make sure that all 3 of these boxes are checked. If they do, your clients will have the clarity they need to move forward. And the tool, again, fast, easy, accurate, delivering that clarity and confidence to help the client move forward. That leads to quick action. We like to say the maybes will drive you crazy. So we want to avoid the maybes so that we can get people moved through the process. Most of the updates we've been working on have not been released yet. They're still in beta. We are going through and testing. We've actually tested our first HTML presentation, which is where you have the ability to publish directly to the HTML web, and you'll be able to send that to a client, and they'll be able to view your presentation in HTML, and they can print their own report as a PDF if they want to. And we're going to wait and release that once we get tested out and get the video portion tested out as well. We did make some small tweaks and stuff to the flyers and stuff this week, mainly related to APRs and some of this disclosure language. Some folks have asked about timing. We think we're 2 weeks or less for the rollout of the dynamic HTML reports, and our goal is to have the video integration done as part of that. So we're about 2 weeks out for the HTML reports and video integration. The mobile report syncs, and the ability to have a report come to you when a client has visited your website or visited the mobile things is another new feature we're working on. These will be great little action reports for you to get to see new opportunities. We're working on, working on the commercial investor module, which is probably about 3 or 4 weeks out. And many of you have seen the Excel spreadsheet that we have for inside of the software. We are converting that over into BSA, so you'll have the ability to model investment properties as well as commercial buildings and things, and do the same nice report that you do now and compare different options. And we've had many people say, I've got clients looking at buying more and more investment properties, and I want to be able to do the same kind of analysis in BSA for that duplex or that triplex or that office building. So we are working on that as an addition. The LOS hot sinking, I had to put a date on this. It's probably 8 weeks because we are working with a couple different vendors. And again, our first goal is to get Encompass and Calyx and a few others, probably 3 or 4 that will go out with the first version, as well as the Fannie Mae integration, so you can import and export with Fannie. We have the export now. We'll be adding the import. And again, there'll be a lot of small little tweaks that you'll see along the way, small things that we can get done as we work on some of these larger initiatives that will hopefully make the software just that much more compelling for you and helping you to grow your business. So with that said, I want to turn this over and get into our conversation with Trevor Hammond, who is our guest today. And we'll spend some time with him trying to suck his brain for any morsels and tidbits and best practices and things that he can share. Then we'll go in and spend time with a few case studies and see if you have any questions. I see a couple people saying they're not getting audio. You should have a dial-in number there. So you can dial in at 218-548-1865 and then 6766 pound for the audio portion. We don't have streaming web. We were having too many problems with that, so we went back to our conference line. So you can dial in there. And of course, the recordings will be live and ready after this event. So let me come over and say hello to you, Mr. Trevor. How are you, sir?
I am good. Thanks for having me.
Glad to have you, man. It's been great. We had you once before and had some tech difficulties and had to reboot, so it's good to get you back on. Well, let me start with just some of the general questions we like to sort of begin with, and that is how long have you been in this business, this mortgage business?
14 years now.
All right, so 14 years. So I assume that as a 14-year veteran, you have seen some pretty interesting changes in the business. How did you get into the mortgage business? What was sort of your entry into the business? And tell us a little bit about how your career has progressed over 14 years.
Back in '98, I fell into it basically. Friend said, hey, go talk to another friend who's in the business. Seems to be making all this money. So I kind of put one foot in and was actually an assistant as a young buck to a very big producer. And I'd say within 45 days, I just knew I could do this, and I knew I wanted to do it, which didn't make her very happy because I was probably a pretty good assistant back then. So the rest is history. I learned a lot back in the day on database management, holding a CRM. And from there, I just started growing a referral-based business. I really had a financial inkling, so I quickly got away from the transactional approach. My biggest pet peeve, and anybody who talks to me hears me talk all the time about just decommoditizing ourselves. And I know that's just a big, gray, fuzzy word like retirement, but it's the best way for me to ever do that, I found, was to educate and be a financial resource, not a loan officer. And nothing wrong with the titles, doesn't really matter what we'd call each other, but I loved the financial part. I ended up getting my degree after a long process in finance. And I like numbers, and I realized that that's where people, you hit it on the head, we're in this business to solve problems, and I couldn't agree more. I mean, that's queuing up, the case study I'll share today, but if I could help solve financial problems, they're going to do the loan with me. They're going to choose my team. So,
and how do you position yourself as a financial resource? Because I know a lot of people they end up being considered a transactor because that's the way they behave. They collect information, they focus on a product, and they do the transaction. They do it very, very well. They do it competently, and the clients are happy. How do you make that shift when you're trying to move from, say, just doing the loan, but into getting that client to understand that you're different, that you're going to help them and really look at this from a financial perspective?
I mean, these days it's pretty easy, but if I kind of go back in my mind when I first started making that shift, for anybody that's still looking to make that shift, it starts with turning into kind of a coaching mentality. I mean, there's some amazing books out there. If anybody's familiar with Daniel Harkavy, of Building Champions, Becoming a Coaching Leader, I really feel that we are coaches to the consumer. Mm-hmm. And what coaching really means, the reason I even bring that up, is you ask a lot of questions. You don't sit there and, spout off about how much you know and facts and figures, because all I really would do is sit back and go, okay, everybody else is doing that. I'm going to go back and ask them a lot more, important questions. And you and I have known each other a long time. I've gotten a lot of ideas from you. But it's asking financial questions. And, before your software was even around, we talked a lot about how is this going to impact your future. One of the couple of questions I've started telling people to ask is, to get them off the fence, is what happens if you do buy this house? And let them tell me. I don't have to have all the answers.
That's right.
Because I think they just sit back and listen to us drone on. And if it's all rates and fees, I know that I'm going to sound like Charlie Brown's teacher when they go home and they've talked to two other people spouting off a bunch of fees and rates and payments. And everybody can do that. If you just, and a lot of it's scripting. To be honest, I did spend a lot of time just perfecting, a lot of scripting we hear from all the guys and gals out there in the industry, but just figuring out 4 or 5 financial questions. What's going to happen if you do buy this house? And then what's going to happen if you don't buy this house?
That's great.
And let them convince
do a what if scenario. Like what if you don't do this refinance? So what if you don't take advantage of the 1% lower rate today? We know financially it's going to cost you $57,000, right? Because you can point out the financial impact of that. But just for yourself, what if you don't do this? What's your alternative? Is it just to do nothing? That's a great way to get somebody to actually paint themselves into a position that they may or may not like. Because again, the maybes drive you crazy. If you can get someone to say, well, I don't want to miss out on $57,000 in savings, then they're probably going to move forward. But if they aren't willing to get clear enough and articulate that, then they could just stay in that limbo land forever.
Absolutely. And the other thing, that I think a lot of people don't do, and the reason you don't get people to, we sit there and beat our heads saying, how can they not refinance right now? How can they not save $300 a month? Well, if they don't tie that $300 to something bigger and more important in their life, then it doesn't have that meaning. We got to help them connect the dots. So, but if you don't ask them the questions like, what would you do with this money? Not saying we have to move forward yet, but the biggest problem I find is people free up $300 a month and then 3 years later have nothing to show for it. Mm-hmm. That means I sold you a transaction. But if I'm a financial educator and a financial resource and my widget happens to be a mortgage, but really I'm solving problems like you said, I want to know what they might do with this $300, only from the aspect I want to make sure they're better off 3 years from now. And I know nobody else is going to take the extra 2 minutes to ask some of these questions. So now they're seeing that refinance and freeing up $300 as a way to finally kickstart that college fund for the kids. Finally, one of the ways they use your software is showing them an extra $300 on that student loan it's been nagging at them forever. And now all of a sudden they're realizing I'm solving some problems just by asking the extra questions. And I'm not saying it to try to sell them or twist their arm. I'm literally, honestly telling them, over all my years, too many people refinance, save a bunch of money, they're all excited, and then have nothing to show for it. Mm-hmm. It's lifestyle inflation. It just gets sucked in somewhere, and they have no idea.
That's a really great point. I in some sales classes that I took early in my career, I was always told to ask someone a closing question by allowing them to share whether or not they understood the implications of what you were saying. So for example, you asked that question. If you said, so you're showing someone $300 a month in savings. You said, if you had $300 a month free right now, what would you do with it? If they can't answer that question, it actually communicates that they still aren't clear on the value of what you're doing for them, because most people operate quickly enough that if you show them 300 in savings, the first thing they do is start to think about what they'll do with it. Will I save it? Will I go buy that new car, etc.? So imagine if I asked Trevor, I said, Trevor, if you had $300 in extra per month right now, free, what would you do with it?
Oh man, I'd pay off this car that my wife had to have. It's just draining us.
Boom. So what I know right now is Trevor's sold. He's ready to go. He's ready to move forward. He's already clear on what he wants to do with that $300 that he's freed up, which means he's already made a decision to do this. And it's one of the most powerful sort of temperature takers in the sales process, is to ask questions that clarify whether or not someone sees the value of what you're doing. You know, if you could take, Trevor, if you could take the $45,000 out that you wanted to take out, how would you use that money?
Well, I'd be debt-free. I'd jumpstart the college fund for little Johnny, and probably take a little trip, actually, because my wife and I haven't had one for 5 years.
So Trevor's found a way to take money out of a house and be debt-free. See, I told you guys he was really smart. But you know, if you took the say you took the $45,000 and paid off all your credit card debt, so I could pay off all of my revolving or installment debt, maybe put some money in college. So again, these are simple questions. If someone says, I have no idea, it's not that they just don't have an idea of what to do with the $45,000. They aren't committed yet. They still aren't sure this is something they want to do. And they won't start investigating what to do with that cash flow or that cash out or that savings or whatever. Again, you could say, if you paid your house off in 16 years instead of 24, what do you think that 8-year difference would be like? It's another way of just doing what? Taking what you see on a page. You're going to be debt-free in 24 years. I can have you debt-free in 16. You can say, I'll have you debt-free in 16 instead of 24. That's one way to say that. But you're speaking something, you're not engaging the client. If you said, what would you do with that extra 8 years of having no mortgage payment? You're pointing out the same thing, but you're allowing the person to do what? To explore and imagine what would they do with that extra 8 years. And if they can come up with anything, then they're committed to the process. And if they aren't, it lets you know that you need to go back in and maybe spend some more time with them. So this is great. This is kicking up some great conversational ideas, and I know you're really good at positioning yourself as a financial educator and a financial coach, and you can build a company around doing that, which I think is really phenomenal. What are some of the other things you would share, that you feel like have really helped you? Trevor, what's your best year, would you say, in the business from a production standpoint?
Oh, somewhere around 40 million, if I looked it up.
Okay.
Around 40.
40 million. So very
Low 40.
Very healthy business. You have a small team. Small team, right? You just have a couple of people.
Yeah, and I am the master delegator. I'm the master of leverage. I'm the master of automation. I knew early on all I wanted to do all day long was educate and meet with people and build the relationships. And I see a lot of people dream of that and say that's what they want to do, but then they're afraid to jump off that ledge a little bit and take on some, cost. They don't look at it as an investment into somebody who adds another 40 hours to your work week by having an assistant. So I look back now at some of those years, and I could have done more business, to be honest, but I enjoyed that consultative approach. I mean, I would spend a lot of time with a client asking these kind of questions, and then the other piece to this whole thing that everyone here, anybody listening, could be doing, take an extra few minutes and find out who's on their wealth team. That's what we call. That's what we call the wealth team. Financial planner, a CPA, an estate attorney, an insurance professional, and not only are you a financial educator, but you're a financial resource, but you're also a financial connector.
Absolutely.
I think I just made that term up actually while I'm talking.
Dude,
I'm going to go with that.
Got to quickly trademark that and get on the get that domain.
Hang on, I got to go.
Yeah, you got to
call my intellectual property, buddy. But if they know that working with me will be a way to connect with other people when they need it, that's all I need them to feel like.
Mm-hmm.
That I'm going to be a resource 6 months from now if they wake up, they see on the news, they read a report, and they realize, you know what, we do need a will. Trevor's the guy to call, and that's really how I positioned my practice for years. I would get all the calls, and I'm able to play quarterback, and we build a lot of systems around that to make sure that happens. So I'm the quarterback, I'm the gatekeeper, and obviously we all know if you refer, a client over to a financial planner, you're probably going to get 10 in return.
Mm-hmm.
And it's just asking the questions and saying, you know what, I'm not just going to sell you a loan and make a paycheck. A lot of people will do that. I'm going to give you the same loan, and I'll make the same amount of money as everybody else, but I also want to surround you with the right people. I want to make sure you've got the rest of your financial life in order. I can't do it all for you, but I've got the right people. And you know what? I'm going to encourage you a month after we close to set up an auto draft for this $300 for free and up, because I want you to have something to show for it when I do an annual review with you.
That's
all they need to hear. Holy cow! They're not shopping you anymore.
That's really cool. And you prompted me to think about, because I'm not sure if in this series of recordings, I know we talk about it and have a video on it in our archives, but we haven't talked about the financial team handout, which is one of the one-page handouts you can attach at the end of your presentation, which is still to me one of the most powerful networking tools that I've ever used, and we built it right into the software, and I bet a lot of people on the call don't even know about it, so I'll make sure we touch on that here at the end of the call and share with you how to use that one page to add 2 or 3 referral partners per loan closing. Let's do this. Let me come over and share out screen here with you. If some of you saw me drop for a minute there, it's because I actually, my internet hiccuped. But hopefully you'll get a little pop-up there, Trevor. Let's see your screen.
Yeah.
And I know you said you had a case study you're going to share with us.
Yes, I do. I'll wait for a pop-up.
Yeah, you should have it now. It should be somewhere over there.
All right, let's see here. Did I say share my desktop?
You can do that too. Yeah, you can go ahead and just click share your desktop. There we go.
Oh, you see my stuff?
I do.
Oh, that's quick.
I do.
Old picture of my daughter and my boy.
All right. Cutie pie. Go ahead and make the air
yeah.
go. Now it's full screen. That looks good.
Is that better?
Yep.
All right. So I've hidden the names to protect the innocent. They really are named C and D. No. This case study, which I know I brought to your attention a while back, was such an epitome of how valuable your tool is, the software is. But what you said at the beginning, I actually wrote down and circled. It's not what the software does; it's what the user does. I hadn't heard you say that before. I probably have missed it. But these guys came to me. One's actually a real estate agent that I hadn't worked with before. So there's a definite plus. They were seeking me out because I was known as the one who could actually help them plan all the stuff going on that they had. They were trying to build a house in this dream little neighborhood that was being built. They had to figure out if they could sell their house. They're both self-employed, well, real estate agent, of course, and then an attorney. And they didn't know how much they should spend. They weren't even sure if they should go forward and buy this place with all of the other stuff going on in their life. And again, I know that some people won't spend all their time getting into some of these variables, but they came at me with all these questions. They were referred by another real estate agent. And I said, the only tool I would have to even show you something to help plan this out is actually the Borrow Smart software. So thank you for that, Todd, because otherwise I would have not had any way to visually show them anything. Mm-hmm. So they came to me and said, okay, here's all our questions. Do we sell now and then rent till our house is built? Do we wait and try to sell it closer to the time when the house is going to be done in January of this year or this coming year? So that means they're trying to sell it in the winter time. Mm-hmm. And you know what? We've got a lot of other debt going on right now. We make a lot of money, but we have a lot of student loans. We've actually forgotten to sock away our tax money. So we're living on 100% of our gross income because we're both self-employed, and we kind of forgot about putting some aside for Uncle Sam. So I was able to plug all this stuff in and ask all the right questions, and they also had plugged 40 grand into this escrow account for this house to be built. The builders, there's only, I think, 13 houses going in, and then they were selling fast. So they had to go sock in 20 grand and then another 20 grand, and there was going to be a point when all that goes hard. So talk about problem solving. It was a doozy. And so what I learned from this is I wanted to have all the solutions for them when they walked into my office. I wanted to have all the answers and say, here's exactly what we're going to do. It all makes sense. And that was pretty impossible, I realized. So one of the takeaways I got out of this that I would want to share is I don't think you need to have all the answers ready when the clients come in. I a lot of times will have the software up. I'll have a lot of the data plugged in with a couple ideas. And then while they're sitting with me, we sit there and play with some numbers. We sit there and go, hey, if we did this, here's what it would look like. You know, and at the end of the day, what they wanted to know was how much do we have to put down? How little can we put down to pay off other debts? And how is our cash flow going to be impacted? And really, I knew that was the ultimate answer. Because they're making plenty of money, but they also have other goals. And again, through asking the questions, just having the conversation, I found out that they had not enough money going towards the college fund for their daughter, and that was a huge goal of theirs. They didn't have enough money going into retirement. Actually, I'll just tell you, zero going towards retirement. And here they are wanting to step up in house. So it was a little tricky. So I put a few options together, even though we're 6 months away, essentially 7 months away when I first met with them. But really what I focused on, and I'll cover whatever you want me to, Todd, but the piece that was huge to them was the cash flow. And I find that with about everybody. It's, here's what my life looks like right now, and we're okay paying, you know, a total of $4,800 out a month with all of our debts. If we go forward and buy this new house with a couple different options, how is our cash flow going to be impacted? And that's obviously one of your three keys, right? Do we have the cash flow to do this? And it was simple. I was able to plug all this in and go, can we afford an extra $577, or excuse me, $677 or $551 or $424? Can we afford that, first of all? And how will that impact all the other things you just told me you want to achieve?
So you've got the 40, you've got that 40,000 there, so they can see right above that 677 in positive month or negative monthly cash flow yields me, you know, I still have 48, or if I've got 23 cash left at closing, my payment's 551, or I can basically come to closing and spend that 40K, and I'm about 424 a month. So it's nice because you can see that that trade-off, because there's always a trade-off in the cash, the down payment and the monthly payment. The bigger the down payment, the lower the monthly payment. As we used to say, the largest down payment you can make is 100%, and when your down payment's 100%, your monthly payment is 0 for the debt portion, right? If you borrow 100%, then you're going to have the highest possible payment. So this is a give and take, and I like the way you've got it laid out there.
And that was the key for them. I do find that the software does answer a lot of questions. We can do all kinds of stuff with it. They're going to come back in, and we're going to use the debt repayment capabilities. So we can help them put the debt snowball in place for them, which is really cool on the repayment page. I think they're coming in 2 weeks. They're supposed to come in actually this afternoon and had to postpone because they've already got an offer on their house, which is cool.
That's great.
That they're selling. But for them, as we walked through this and just dialogued, my main point here is I didn't have to have all the details. I literally were out a ways. I rough numbered the closing costs, the rates. I gave them estimates, and I made sure they didn't focus on that because by the time we close, it could be totally different. And you'll see, I think for most of these I put in 4%.
Sure.
Well, they can get lower than that right now, of course. And they questioned me on that, but I said, we have access to all the same rates. We're going to get you the best rate, but let's not make our entire financial plan on getting 3.5.
And we talked about
that.
Yeah, we talked about that on our call last week, that the problem was starting with your absolute best lowest rate. is that you make that into a transactional condition of the loan, and it goes up an eighth and the client's unhappy. Start a quarter higher and just say, let me just show you the concept here. Your actual rate could be lower, and of course you know going in that it will be. Give yourself that room, because if they tell you that, well, I'm going to go somewhere else for a lower rate, I mean, you know you have a lower rate, but you already know where that client's head is, and you can address it early on in the process. I really like building that cushion in. I think people just are conditioned to try to give their very best, lowest rate up front. And oftentimes the value of the advice is so powerful, you don't need to do that.
Well, a quick trick on that, not even a trick, I shouldn't even use that word, that's horrible. But if you are using a rate watch type of service like Mortgage Market Guide, right?
Yep.
You just show them, all they need to do is see that you've got your finger on the pulse of the market. You're tracking it daily. When the time comes and you've actually gotten into your purchase agreement, and we know when the closing date is, we're going to get the best rate, and here's why. I'm tracking it all the time for you. But now let's step back to that 30,000-foot view and look at the concept as you just said, Todd. Just let's figure out the best way to structure all this and plan out all of this cash and cash flow so you can go home and actually sleep tonight and have a plan in place. Because I'm big on if you just have a plan, you're going to feel better. You're going to go out there and you're going to shop, you're going to feel comfortable, and we can tweak it as we go, and rates will change, but at least you know how to do this, whether it's 10%, 15%, 20% down. So that being said, with these clients, cash flow is their strength. Cash is their definite weakness. So after they saw the numbers, for these folks who make, I probably saw on the other screen, they make about $180,000 a year with a lot more potential, but with uncertainty because they're both self-employed. A real estate agent goes up and down. This difference of, $253 a month didn't faze them at all. It was all about how much cash can we have left over to then put towards our other debts.
Gotcha. So that gives you that.
If you saw the list up here, we had some stuff to do with it.
Yeah, you've got that pivot. I always call it a pivot, where you can pivot back and forth and say, what's worth more to you right now, the $250 a month or $48,000 cash? Because that's really now your pivot for that decision, and it makes it easier for them to see that. Well, to me, I'd rather have the $48,000.
Well, and I would go right back up and I go, where can we get the most bang for our buck? Because you can get rid of all that extra cash, that $48,000, and save $250, or we could go use 8 of it and knock out $355.
Beautiful.
30 of it to knock out another $237.
Mm-hmm.
And we still got money left over. We still got $10,000 left over, and we've wiped out, I don't know, $600,
wow,
roughly.
That's cool.
So they got it. They're like, wow, okay. And you and I talk about a lot, Todd, but the highest and best use of your cash flow and your cash. Yeah, that's what it all comes down to.
There's a critical point here that we've said it, but I want to make sure you hear it in this context, and that is people live lives of cash flow, meaning their confidence is tied to their cash flow. Wealth is an important consideration, but it's a secondary consideration. Someone will not trade off their current cash flow for an opportunity to have more wealth later in some cases. We see it time and time again. They're so cash flow oriented, and that's why it's really critical to focus on the payment. And there's another point I want to make here about what Trevor's doing, and it's based on a conversation I had with a loan officer last week. He's a younger guy. He's been in the business about 3 years, and he said to me, he goes, I love this stuff. I'm so fascinated with the numbers and being able to show people this, but I just don't have time. I feel like I need to be, going out and talking to new prospects, and I need to be filling out the application. I just don't have time to do this. I said, look, there's a difference between being efficient and being effective. Efficient is doing things faster. Effective is doing the right things. And what Trevor's saying here, and he said this because he enjoys what he enjoys doing, because he's doing what he enjoys. He enjoys this part of it. And some of you guys on this call and other people I talk to feel like they want to do this more and they don't have time. And I'm telling you, if you do this more, you will have the time because you'll become more effective, because this is what people are valuing. This is what they're paying you for. they'll tell their friends, they'll tell their referral partners, and you will not have to spend so much time trying to find new bodies based on a transactional model. So focus on effectiveness. You could spend an hour with a client doing this and have someone in your office fill out the 1003, and you might feel like you spent way too much time. But if you really take good care of that client, they understand what they're doing and why, you'll be amazed at the results over time. So don't worry about spending a little more time, and also don't worry about doing this. This is one of the things that I keep hearing as we've had people switch over from another product, is that the other product doesn't allow them to have this conversation. That the other product that they've used in the past was in little chunks, and they couldn't tell a story because the only thing they could do is get to the end and try to create a presentation. But so much of this is dynamic. We built this so that on one page here you could literally go through, and based on the client's focus and interest, if they're interested in cash flow, focus on the cash flow. If they're interested in the financial impact over time, then you can scroll down and focus on that. And again, don't be afraid to do this dynamically when you're sitting there with a client. This is great, Trevor.
I hope it helps. We are thinking alike. I will chime in too. I hear most recently from a loan officer who I know well and I actually coach. He's gotten inside of a Keller Williams office. Great opportunity. He's already a heavy hitter, does a lot of loans, does great business, but his system wasn't quite ready for all these leads that he was getting.
Mm-hmm.
And he started cutting corners. He stopped asking some of the questions. He was in a hurry. He stopped taking this approach and really taking the time to get people to feel comfortable and make a good financial decision. And I'll tell you what, he just had one of his best agents call him because he lost three of the people that she had referred over, and said, Mike, what's going on?
Wow.
I've never had 3 people in 1 month go elsewhere and choose the competition. So of course he comes to me, he's like, man, what's going on? And I started asking questions, and it was just that. He was so busy trying to chase down more relationships and more leads, yet actually he loses a ton of time because he now has to go find more clients to fill the 3 he just lost.
And new referral sources.
Yeah, exactly, and jeopardy of losing that one who isn't getting great feedback. So it actually will save you time if you just convert more, like you said on that one slide. Convert 70% more. I don't think you'll have to worry about it. You won't need as many leads if you just convert more.
Yeah, I talk to advisors who are like, I refer clients out to loan officers, and they handle them so poorly, and they don't seem to understand that if I could find someone that really took good care of my client the way I do, I have hundreds of clients that I could refer them over the next 3 or 4 years. And we're so busy trying to, again, get through that one lead and get to the next lead, and I think we're really missing some opportunities here to build relationships. We don't know what's behind that next transaction if we take really good care of that referral.
Yeah.
So how did you bring these guys home? Did you? I know they're still in the process right now. Is there anything else you had to share with them in this process? It's leading to future meetings, all kinds of good stuff, and they were able to get clear about putting the least amount down they're able to. And they're coming back in, like I said, because I'm just going to help them map out what to pay off. We're gonna apply the debt snowball you've got in the system on the repay page, and they'd never heard of that. I seem to have a false belief that everybody's heard of the debt snowball, but a lot of them haven't. And to have it built into the system, I don't know if I've got it all ready to go to even show you, but I'm basically going to show them taking the extra money, either the cash flow or the cash to pay off some of the debts, how much faster we'll actually be debt-free except for that house. Mm-hmm.
The stress in their life is from all of this stuff.
Yep.
Sallie Mae, some IRS, and the lack of savings. So, I'm just kind of putting on the coaching hat for these folks and really walking them through some of my systems to help them put a savings plan in place and then a debt elimination plan in place. And your software luckily has the debt snowball built into it. So it makes it easier to present it to them and see the power of it. And then it's just being a partner with them and just really helping them stay on track.
Well, let me ask you, now you're obviously you've got a loan opportunity here. When you do this kind of additional work, there's tremendous value here. Do you charge clients additionally for this type of education or coaching?
Yes, I do.
What would you
Yeah.
what would you typically charge someone like this?
These guys are paying me. I cut them a deal, to be honest, but $200 a month,
Mm-hmm.
and I meet with them for 1 hour each month.
That's phenomenal, and
And
that's another mindset that a lot of advisors, financial advisors, make a living coaching people on this stuff. And what we're doing here, as we talk about this, is really being in a position to coach people. And I don't know how many people on this call have ever considered charging for their advice in that way, but this is evidence here that you can do it. I didn't mean to interrupt you there.
Well, no, I wasn't sure if you wanted me to talk about it too much, but because that's a whole other call. But I've been doing it since 2005, to be honest.
Mm-hmm.
And this client in particular, and I'm so busy with other things and coaching, a group of loan officers and running another business as well around financial education. These guys came to me off a referral, and I wasn't trying to do the whole takeaway. I said, you know what, I really just don't have time to coach you and to really help you plan all this out as much. I'll meet with you the one time. They actually, begging is too strong of a word, but they convinced me to do it and to be able to pay me because they said nobody else does what you do. And that was one of those taps.
Yep.
I was like, you're right. You're reminding me that nobody else does this stuff out there. And this is a real estate agent who knows a lot of loan officers out there. They're coming to me who doesn't even normally do loans for their clients and saying nobody else does what you do, a coaching, planning approach around real estate.
Wow, that's powerful. That
yeah.
was really,
so it
really
was cool.
Cool.
So I'm working with them.
That's awesome.
I'm helping them out, and they're fun because I didn't sell them or convince them. They saw the value, and they actually asked if I would at least take them on. And now they've already referred somebody else to me, who now I have to decide if if I'm going to take them on and work with them.
Yeah, one thing I've heard is when you actually start doing some coaching and someone refers you a customer, they come in with the idea that you're going to coach them. And if you like that, not only doing the loan but paying and earning some additional coaching revenue, you start to breed a new type of client. You breed a new kind of referral because it's not a question of whether or not they've ever heard of it. They heard about you from somebody that you're coaching. And if they haven't really talked to them about it and they know they're being coached and they come in, they'll often start with, I understand you're coaching them. That's something we'd be interested in. I mean, that becomes a pretty cool conversation because you might coach someone for 3 or 4 months after their loan closes, just helping them get things in order. And that's a nice side business. It's a nice additional opportunity to build that relationship. And again, get more referrals. I mean, what's the new referral worth to you if you just do a loan for them?
Yeah. Yep.
Well, this is awesome, man. I really
it's not a lot of money, so anybody thinking about that, it's not like it's a bunch of money. You get paid several thousand to do a mortgage, get paid a couple $100 a month to coach, but it's that relationship piece, and you got to really enjoy it. I mean, you get a lot of fulfillment out of just helping people beyond the mortgage.
And so many people, they don't need a rocket science type plan. They just need someone to have a little. The accountability is the most valuable thing you can do for people.
Yeah.
Is to say, if you come in once a month, I'll help you make sure that all the things are being paid off in the right order. We'll get this figured out. It'll only take a couple of months, and then you'll be into. People say, how long do you coach someone? I'm like, well, you coach them until they don't need your help anymore. But if you're going to initially set up a coaching type environment, simply say, I can get most people up and going in just a couple of months. So if you charge $200 or $300 a month to do that, they understand the cost and the benefit of what they're going to potentially get from that. And I tell you what, chat in there your email address if you don't mind some people calling you about your coaching and your MFIC program, because there might be some people here that want to learn a little bit more about that as well. And I really appreciate your time today because, again, you shared some great insight, and as all these things, you prompt a lot of great things for people to consider. Any last things here before I jump over?
No. How do you want me to share my email? I'm not sure how to do it.
You can chat it. I'll stop the sharing here and take it back over, and you can just chat it over there in the box. Cool. All right, so let me just share back out for a second. And this was such good stuff. I'm running over on my time, but I will go through. And let's look at a couple of case studies. Hopefully everybody's seeing my desktop. I had one that came in, I think it was from Mr. Stillman, came in on the on the partially paying off a HELOC, and another one that came in on buying a new house and renting. And what I really want to do is kind of show you on the case itself a couple ideas for setting up that kind of a case study. So while Trevor pops in there his information, I'll go over here and share with you these two case studies. So the first case study, and for time I won't go into great detail, but you should be able to follow along. The client has a first mortgage, 30-year fixed, and a second mortgage, a 10-year draw with a 25-year term. They owed $370 on the first and $230 on the second. So that's the setup. And the goal was, with this loan officer, and if you're on the call, hopefully I'm doing this justice as to my understanding, was that because the house was worth $972, there was plenty of room to consolidate both of these into one new loan of $600,000. But what happened, due to either the credit score or something else, they could only end up getting a first position to the 417 conforming limit. So what that really meant was, if you could only do a first position to 417, that meant you couldn't pay off all of the second mortgage. You could only pay off a portion. So if you put in that 30-year fixed at, say, 417 and 3 3/4, if you know, when we look down below here, the cash said there was going to be $44,000 of cash available. So the way we did that, and the way you can do this type of a scenario, is say yes and yes. So even though you're not paying the second mortgage off in full, say I'm paying off the first mortgage and the second, and then come down here and put in the new 30, and then just put in a new equity line. It's going to be the old equity line, but with the new balance of 186. And you'll notice we put the same interest rate. So 3.5 is the current rate. This would be the new rate of the old rate of 3.5, because this is really the same mortgage, but you're just going through and buying it down. And by doing that, you'll notice that the cash out at closing is 0, because what's happening? They're borrowing $600 now. They're borrowing $603. Why $603? That's to cover the $3,000 in closing costs. And again, I like this.
Todd,
yeah.
I don't think people can see your screen.
They can't? Oh my gosh, well thank you for sharing.
Sound fantastic though.
Huh? The sound is fantastic? Oh, let's see. Okay, well why would it not share my screen? Let me share again.
I see the screen, but I'm watching the chat box. I see it, but
all right.
Some people don't.
All right, are you seeing it now? Can you see it now, Trevor?
I've been able to see it. I'm watching the chat box.
You may have to, if up on the tab up there, look at your tabs in the top. I may not have closed out Trevor's tab for everybody, and so you click on my tab, and it should show you the information. And I apologize, but I should be live. Trevor, you probably closed your tab, and that's why you're seeing my tab. If you see a couple tabs up there, there's probably one that says Trevor sharing. Just close that, and then you should see the one that says Todd sharing. Is that helping everybody?
I think you're seeing it. Larry's saying he sees it.
Okay, great. Great. And we only got a few minutes to go, so if you miss this part, you can catch on the end of the video. I apologize, but hopefully it'll, if you just close out Trevor's tab, you'll be able to see this okay. So again, for those of you who can now see, I was blind and now I can see. All we did is we just simply took a first mortgage and a second mortgage, and we split into a new first, and we kind of mimicked a new second, even though it's the same second. And to do that, the other thing you want to do is you want to just open up the ARM details and put the ARM details in exactly as they are or were at the beginning of the mortgage. So 1 month, 1 month, 6.5. I mean, that's going to flow through, and this is going to give you a very good, even if it's not perfect, it's going to give you what you need to be able to show someone you're borrowing 600 here, you're borrowing 603 here. You're going from 5.875 to 3.75, and you're keeping your 3.5 at 3.5, but you're doing it with a lower balance. See, I can tell the story right here. And I can go down to the closing costs. You got no out-of-pocket, check. Cash flow-wise, you got an extra $711 a month, check. And then we can come on down here and look at the savings over in the next 15 years, which is their target time period. This is going to be worth $109,809 for you. So again, we're trying to go check, check, check. Do all three work? Because it's that simple, guys. If you can say check, you're okay with the closing cost, no out of pocket. Check, you got an extra $711. Check, this is going to be worth $109,809 to you over 15 years. then if they don't move forward with you, there's something else going on that you need to understand, because you've eliminated all of the roadblocks. And if you want to use the repay screen, which Trevor's fond of, then one of the things you can do is say, and our goal with that 711 would be to prepay the HELOC first. So click snowball lowest balance first, because they only have two loans. They have the first mortgage and the second mortgage, and the second mortgage is the lowest balance. So if I say I want to pay off the lowest balance first, here's what they're doing right now. You can see that best case they're debt free in 23 years, 7 months. And now come down below and notice all that extra 711 right now monthly is going to repay. And because we said repay lowest balance first, you can see that that equity line is being paid off in 21 years, and the HELOC, or the mortgage 30-year fix, is being paid off over here. But the client has the potential to be debt-free in as fast as 14 years, 1 month. So it really gives you, again, a cool ability to tell a story. And I just wanted to show you that's one way to set up if you have a situation where a client cannot prepay a second. Just go ahead and move that second over down here. The second one I wanted to show you, just in terms of way to set one up, and this came in from another loan officer, and we renamed it John Sample. This came in from Maryland. You can see this is the client situation. They have a lot of income, $212,000 in income, the 35% tax bracket. They have a first mortgage, a second mortgage, 2 autos, and 3 credit cards. So what they can't sell their current house, but they want to buy a new house. So considering purchasing a new primary and would rent the existing home. So, you know, this is a question that's come in before, so I thought it'd be a good one to cover. What's the best way to do that? Well, this is a purchase, because you're not refinancing, you're buying a new house. So one of the mistakes people will do is they'll put in a refinance, and just make sure you select it as a purchase, because these are all the current liabilities that you have today. When you go to the Borrow tab, okay, you're going to have no in all of these fields, because you're not paying off any of these debts. You owe $334 now, you're at 5.041, none of this is changing. What you're doing, though, is you're buying a new house. So it's going to say, what's the property value? You're buying a $499 house at a $499 contract. And this person was doing, it looks like a FHA loan, 30-year fixed, 96.5, 42,404, 4.625. And I didn't put this in, this is just what's in here. And I'm just wanting to show you how they set it up. So this is the new first, and you'll notice all these liabilities are still here. So you were borrowing $334, you're now going to be borrowing $817. But the ratios are 18:33. So as long as that works for you, you can still tell the story, right? Because we're talking about how do you tell the story. And you'll notice the same thing here. He just modeled a 5-year ARM. So he's modeling a 30-year fixed and a 5-year ARM. He's modeling that at 3.75. So can I answer the 3 questions? What's the cash impact? They have $25,000 available. So if they don't buy the house, they'd still have $25,000. If they buy the house, they'd have $6,600 left in both of these scenarios. On the cash impact, they're spending $25.43 right now. They'd be spending $46.04 and $44.81 after tax. So you can see the payment difference of $20.61 or $19.38. So there's your payment difference. And note what we did here is they were going to rent for, say, $1,500 a month. Then what we did is we just went through and said they're spending $30.18. Here they're spending $58.21 out of pocket. And then we just went through and clicked add $1,500 a month as rent income. And now that's going to be reflected below as income for this particular mortgage. You're going to see that as income. So if I expand payments into the detail, you'll see rental income, $126,000 of rental income over 7 years. If you expand out the payment breakout, you can see where that's being factored in. So can I answer a question for them? In 7 years, the first question is, do you have the cash to do this? Yes, you do. You're going to be left with about $6,600. Second question, can you handle the monthly payment difference? I can't answer that for you. Can you handle an extra $2,000 a month? The ratios say that it can work for you if you're comfortable with it. The third question is financially viable for you to do this over the next 7 years? Now he was using a 3% property appreciation rate, a 1% savings rate, which would be like, you know, passbook checking or whatever, and we got a time frame of 7 years. So, but if the time frame's 10 years, I can just slide it out, and we can see then the 30 years is a much better idea than the 5-year ARM if you're going out, say, for a 10-year time frame. If that's how long it's going to take them to maybe get that house sold and do the other stuff that they want to do, then I'm going to look at the 30. If they said, I think probably 5 years would be enough time for us to sell that other house, and when we sell it, we'd like to maybe refinance and pay down our first mortgage some more, then I'd look at these and say, well, then let's look at maybe a 5-year time frame. And if they said, I'm not sure, well, is 7 going to get you closer? If 7's going to get you closer and you want to do it as quickly as you can, I'd go with a 5-year ARM personally, because that gives you about the same wealth impact over 7 years. But anything, if you could figure this out in the next 3 years, you sell that house and you're able to do it, then that's going to be a positive for you over a shorter time frame. That 5 years going to pay off for you a little bit more in those first couple of years. Not a lot, but 7-8 grand, beats a sharp stick in the eye. So just 2 different ways to think about setting up those types of cases, because they're a little more sophisticated. But if you've got a client that's going to buy a new house, you can show them buying that new house and just adding that liability on top of their existing liabilities. And some people will just do a new purchase. One of the questions I've had come in is, why would you do this? Why don't you just show a new purchase transaction of $499 with a 30-year fix and leave all this off? I'm like, because then I miss the opportunity to make sure this client's comfortable with the fact that this is their real situation. This is what they're spending now. This is what they're going to be spending. And if I competed with somebody and the other person did just the new purchase and I did this, I think I'd win this every time, because I'm going to go through and talk to them about their cash flow and what they're comfortable with, and again, answering these 3 key questions. Now, I did want to share with you that one big thing here before we wrap up, and this is something that a lot of people don't understand how to use, or maybe you've never heard of it. Trevor mentioned it. It's called your management team. So let's just say I was building up a plan for this particular client. You would never catch me in a million years doing a plan and not checking this box. So I probably should be a little bit more aggressive about explaining the impact of it. But what this does is when I go through and create this plan for this particular client, this is going to append a single page to it called your management team. So let me create the report, and I'll show you what that particular thing does. And I will guarantee everybody on this call right now, if you do this with your next 5 clients, you will end up in front of at least 3 to 5 new referral partners. And if you don't, email me, and I want to know why. If you follow this the way I'm going to explain it to you, you will be in front of some new referral partners. So we've got our nice little 2-page plan, our program matrix, and here's that 5th page. It's very simple. It says, I want to build a great team, a financial team to support you. The person that I want to be on this team is your residential lender. If you're an advisor, you could say, the person I want to be on this team is your financial advisor. So the first thing I have to ask you, how are we doing so far on a scale of 1 to 10? How do you feel like I'm doing? And you would write in your name right here where it says residential lender and ask them how you're doing, and circle that number, okay? And then you say, do you have a financial advisor you work with today? And if they say no, then all I do is I go over here and check that box, need to identify. Do you have a realtor you're working with today? You do, great. Gloria Smith, great. Tell me, on a scale of 1 to 10, how is she doing for you? How do you feel about that relationship? Great, so she's a 9, awesome. CPA tax advisor, do you have somebody you're working with? Great. Tell me about that person. There are 4, okay, great. So now here's what I do. If they put a 4 down, I check need to identify. They don't need a lender because they like me and I'm doing a good job. They don't need a realtor because they have someone and they're doing a good job. They didn't have a financial advisor, so I check need to identify. If they put CPA tax advisor in a 4, I would come over here and check the box, and I'd look at them and say, let me ask you a question. If I could put you in front of a 9 or a 10, based on other clients I have who've told me that their CPA is a 9 or a 10, wouldn't you rather have someone like that on your team? If I could introduce you to that person, would you be open to meeting with them? It's a yes or no question. And they would say, yeah, I'd be willing to meet with him. Now let me ask you, on the financial advisor, you didn't have anybody. I've got some financial advisors that are often getting an 8, 9, or 10 from the clients that I work with. Would you mind if I introduced you to one of the financial advisors that's consistently getting a 9 or a 10 with my other clients? You would? Great. I'll give them a call. and they'll probably reach out to you directly. And all I ask is that if they call you, that you're willing to sit down and meet with them. Is that fair? Great. They leave the office. What do I have to do now? I get to call 2 referral partners and say, I just talked to this client. They didn't have a financial advisor, and they were open to meeting with you. That is a wonderful call to make. The second time I call the CPA, I say the same thing. Right? I've got a client. They've got a CPA now, but they said they were a 4. You're a 9 for me, and that's cool. Now, the other thing that I would do is every time a client gave me a name of a financial advisor or CPA that was a 9 or a 10, if I didn't know them, guess what I did? I called the financial advisor and say, I just met with Trevor Hammond, and evidently we have a client in common. And you know what? The reason I'm calling is because I asked him if he had a financial advisor, and he said he did. And I asked him on a scale of 1 to 10 how that guy was doing for him, and he gave you a 10. I was really, really impressed. Would you mind if we meet? Because I have other clients that are looking for advisors that are 10s. And I think if you got a 10 with this client and you're getting a 10 with other clients, we need to meet. And what do you think those advisors said when I made that call? Absolutely. We have a client in common. They said I was a 10. You're looking for an advisor who's a 10. You've got other clients looking for people like me. You will get 100% receptivity on that call to meet with that advisor. And guess what? You've got a new relationship that you can develop. So every single one of these boxes is an opportunity. If they're high scores, you want to go meet them to tell them that you want to get to know people like them to refer your clients, because you are. And you can actually take your sheets in there and show them this process that you use and how you're constantly referring people out. This is a phenomenal referral strategy that I hope you guys will take me up on this challenge to use it for your next 3 to 5 clients. And just go back and listen to this if you need to get the languaging down. It's so simple to do, and it really can have a phenomenal impact on some of the people that you get a chance to see week after week. One new client can generate 2 or 3 new referral partner opportunities for you to go out and see. So hopefully you picked up some great ideas today. Let me just close out here and make sure I don't have any other questions here that I haven't answered. Who is Trevor using as an investor for the 10% second mortgage? Trevor, you still on? Do you know?
Yeah, I've already been answering all that.
Okay,
so.
cool. And then, Jack, do you have the ability to add odd years mortgages in the development pipeline, 8, 9, 10? We're looking at that. We're looking at the ability to have a widget that would allow you to create some custom programs. And it's in our development queue. Tad is actually developing sort of an idea for how that might work. It has some challenges because of our reports and some of the other things that we do, and do we just basically not, we just got to think it through. But yes, the answer is we're looking at that as a possibility to create some additional, just sort of, you got boxes where you can create custom programs and save them right there. In the meantime, we are adding, like right now, for example, we're adding a bunch of, some ARM products that have a 15-year draw and a 25-year term instead of a 10-year draw and a 25. So we're adding all 3 of those next week. And we don't mind adding products. So if you've got products that are out there being used or somewhat, they're not completely, I've never heard of them before, but they're somewhat mainstream, we'll add those programs in for you as well. So anyway, hope you picked up a few great ideas today. Wish you the best, and we should be on for next Thursday at the same time. Please tell your friends about us, and we wish you the best. Have a great day. Thanks again, Trevor.
Yeah, thank you, Todd.
See you, man.
Bye-bye.